The world watches with bated breath as the global financial landscape stands on the brink of a potential transformation. The United States, a key player in the international financial system, contemplates a move of potentially seismic proportions. The possibility of withdrawing from the International Monetary Fund and the World Bank has sent shockwaves through financial circles worldwide. These institutions, which have been the cornerstones of the global financial system for decades, have provided stability and fostered economic development across the globe. The prospect of a U.S. exit raises profound questions about the future of global financial governance and the role of the United States on the world stage. It challenges the very fabric of international cooperation and economic diplomacy. The implications, both domestically and internationally, are far-reaching and demand careful consideration. The ripple effects could alter the dynamics of global trade, investment, and economic stability. This potential shift in policy reflects a growing sentiment within certain U.S. circles that these institutions no longer serve American interests. There is a belief that the benefits of membership are outweighed by the costs. Critics argue that the IMF and World Bank are bureaucratic, inefficient, and overly generous to developing countries at the expense of American taxpayers. They claim that the funds could be better utilized within the United States. Proponents of withdrawal advocate for a more unilateral approach to international finance, prioritizing American economic interests above all else. They envision a future where the U.S. can negotiate directly with other nations without the constraints of multilateral institutions. However, such a move carries significant risks. The interconnected nature of the global economy means that instability in one region can quickly spread to others. The IMF and World Bank play a crucial role in stabilizing the global economy, providing financial assistance and technical expertise to countries facing economic crises. Their interventions have often prevented economic downturns from becoming full-blown depressions. They also promote economic development in poorer countries, fostering growth and reducing poverty. Their projects have built infrastructure, improved education, and enhanced healthcare in many parts of the world. A U.S. withdrawal would weaken these institutions, potentially leading to greater global instability and undermining American leadership on the world stage. The absence of the U.S. could embolden other nations to follow suit, further fragmenting the global financial order. The decision of whether or not to withdraw from the IMF and World Bank is a complex one, with far-reaching implications. It requires a nuanced understanding of both the benefits and the potential drawbacks. It is essential that policymakers carefully weigh the potential costs and benefits before making a decision that could have profound consequences for the global economy and the role of the United States in the world. The stakes are high, and the outcome will shape the future of international finance for years to come. To understand the gravity of a potential U.S. withdrawal, it's crucial to grasp the historical context and the foundational roles these institutions play in the global economy. The International Monetary Fund, IMF, and the World Bank are two of the most influential financial institutions in the world, each with distinct but complementary roles. These institutions were born out of the ashes of World War II, a period marked by global economic devastation and a desire to prevent future conflicts rooted in economic instability. The devastation of the war had left many countries in ruins, and there was a pressing need for a coordinated effort to rebuild and stabilize the global economy. The architects of this new world order envisioned a system where international cooperation and financial stability would be paramount. The IMF was tasked with maintaining global monetary cooperation, stabilizing exchange rates, and providing short-term loans to countries facing balance of payments crises. Its mission was to prevent a repeat of the devastating currency wars that had exacerbated the Great Depression, which had led to widespread economic hardship and contributed to the rise of extremist political movements. The IMF's role in stabilizing exchange rates and providing financial assistance has been crucial in maintaining global economic stability. By offering short-term financial support, the IMF helps countries navigate economic crises and avoid the kind of economic turmoil that can lead to political instability and conflict. The World Bank, on the other hand, focused on long-term economic development, providing loans and grants to developing countries for infrastructure projects, education, healthcare, and other poverty reduction initiatives. Its goal is to reduce poverty and support sustainable development by funding projects that improve living standards and economic opportunities in the world's poorest countries. Together, these institutions have played a pivotal role in shaping the global economic landscape. They have provided a framework for international financial cooperation, facilitated trade and investment, and helped lift millions out of poverty. They have provided a framework for international financial cooperation, facilitated trade and investment, and helped lift millions out of poverty. The IMF and World Bank have been instrumental in promoting economic growth and stability, particularly in developing countries that lack the resources to invest in their own development. Their successes are undeniable, but they have also faced criticism over the years for their policies, governance structures, and the perceived dominance of developed countries, particularly the United States. Critics argue that the IMF and World Bank often impose harsh economic conditions on borrowing countries, which can lead to social and economic hardships. Despite these criticisms, the IMF and World Bank remain essential institutions for global financial stability and economic development. Their ability to adapt and respond to changing global economic conditions has been key to their longevity and continued relevance. Their continued effectiveness relies on the active participation and support of their member countries, especially those with significant economic influence. The cooperation and commitment of these countries are vital to the success of the IMF and World Bank's missions. The potential withdrawal of the United States, a founding member and major shareholder, would undoubtedly have a profound impact on these institutions and their ability to fulfill their mandates. The U.S. has played a critical role in shaping the policies and direction of the IMF and World Bank, and its departure could lead to significant changes in the global economic order. The United States has held a unique and powerful position within the IMF and World Bank since their inception. These institutions were established in the aftermath of World War II, with the aim of fostering global economic stability and development. From the very beginning, the U.S. played a pivotal role in their formation, and has continued to exert significant influence over their operations. This influence stems from its position as the world's largest economy for much of the post-war era, its substantial financial contributions, and its strategic interests in maintaining a stable global economic order. The US dollar, as the world's primary reserve currency, further cements its influence in these institutions. The historical role of the United States in shaping these institutions cannot be overstated. The Bretton Woods Conference, which led to the creation of the IMF and World Bank, was heavily influenced by U.S. economic policies and priorities. The U.S. holds the largest voting share in both institutions, giving it significant sway over decision-making processes and policy direction. This voting power allows the U.S. to influence key decisions, including the approval of loans and the implementation of economic policies in member countries. This influence has been a source of both praise and criticism. On one hand, U.S. leadership is seen as a stabilizing force that promotes economic growth and development. On the other hand, it is viewed as a means for the U.S. to advance its own interests. Proponents argue that U.S. leadership has been essential in guiding these institutions to promote free markets, economic liberalization, and global financial stability. They highlight the role of the IMF and World Bank in fostering economic reforms and supporting countries in times of financial distress. They point to the IMF's role in mitigating financial crises in Latin America, Asia, and Russia, where timely interventions help stabilize economies and restore investor confidence. Similarly, the World Bank's contributions to poverty reduction and development projects worldwide are often cited as examples of the positive impact of U.S. influence. These projects have provided critical funding for infrastructure, education, and healthcare in developing countries. However, critics contend that U.S. influence has often been used to advance its own economic and geopolitical interests at the expense of developing countries. They argue that the policies promoted by the IMF and World Bank sometimes prioritize the interests of wealthy nations over those of poorer countries. They point to instances where IMF loan conditions have been seen as overly harsh, imposing austerity measures that disproportionately harm the poor and vulnerable. These measures often include cuts to social spending, which can lead to increased poverty and inequality. Concerns have also been raised about the environmental and social impact of some World Bank-funded projects, particularly large-scale infrastructure projects that displace communities or damage ecosystems. Critics argue that these projects sometimes prioritize economic growth over environmental sustainability and social well-being. The potential withdrawal of the United States from these institutions would undoubtedly have a profound impact on their governance structures and policy agendas. Such a move could lead to a significant shift in the balance of power within the IMF and World Bank. It remains to be seen whether other major shareholders such as China or the European Union would be able to fill the leadership vacuum left by the US. These countries have been increasing their influence in global financial institutions, but it is unclear if they can match the level of impact historically exerted by the United States. The shifting dynamics within these institutions could lead to new approaches to global economic governance. As the balance of power changes, the policies and priorities of the IMF and World Bank may evolve, reflecting the interests and values of a more diverse group of member countries. The potential consequences of a U.S. withdrawal from the IMF and World Bank are numerous and complex, with the potential to send shockwaves through the global financial system. One of the most immediate concerns is the potential for institutional weakening. The U.S. provides a significant portion of the funding for both institutions, and its absence would create a substantial financial gap that other member countries might struggle to fill. This financial shortfall could hamper the ability of the IMF to respond effectively to future financial crises. Without sufficient resources, the IMF might be unable to provide the necessary financial assistance to countries in need, potentially exacerbating economic downturns and increasing the risk of contagion. This could lead to a more volatile global economy, with increased uncertainty and reduced investor confidence. Moreover, the loss of U.S. leadership and expertise within these institutions could hinder their effectiveness. The U.S. has historically played a key role in shaping policy, providing technical assistance and advocating for reforms. Its absence could create a void in leadership, potentially leading to policy paralysis, a lack of direction, and a decline in the quality of technical expertise provided by these institutions. This weakening of the global financial architecture could have far-reaching consequences, not just for developing countries that rely on IMF and World Bank assistance, but for the global economy as a whole. A more unstable and less predictable global financial system would benefit no one, and the risks associated with U.S. withdrawal should give policymakers serious pause.